Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Alphabet.
If you find our talks useful, please consider subscribe, like, and comment underneath. So before we start, I want you to just imagine a company spending the entire gross domestic product of New Zealand on, like, server racks and industrial cooling systems in a single year.
Right, which is just an unfathomable amount of money.
Exactly. And the crazy part is Wall Street is actually begging them to spend even more. That's exactly the reality Alphabet is operating in right now.
Yeah, the narrative shift we're seeing here is, it's nothing short of dramatic.
For sure, because if you rewind just, a year or two, the market had essentially written this company off as the dinosaur of the AI age. Like, the consensus was that they were caught completely flat-footed by nimble startups.
Well, yeah, but today,
Yeah,
the market has officially crowned them the definitive AI leader.
totally. So our goal today is to break down exactly how they engineered this monumental turnaround. We're going to look at the mechanisms driving these jaw-dropping numbers and figure out what this structural shift means for your wealth-building strategy.
And, this turnaround, it's really rooted in a massive operational pivot. They didn't just change their marketing or, slap the word AI onto old products.
Right, they didn't just rebrand.
Exactly. They fundamentally shifted their revenue engines. They stopped just participating in the AI software race and started providing the foundational infrastructure for the entire global AI revolution.
And to really understand that sudden shift in market perception, we have to look directly at the staggering top-of-line momentum they reported to kick off 2026.
Oh, the Q1 numbers are an absolute blockbuster.
Yeah, consolidated revenue hit $109.9 billion.
Which is a 22% year-over-year increase. That marks their fastest growth rate since, 2022?
Yep, 2022. I mean, they basically generated in 3 months what most major global corporations take a decade to earn.
Yeah.
But the undisputed star of the show was Google Cloud.
Oh, without a doubt. Revenue there surged 63% to $20.03 billion.
Which absolutely crushed the $18.05 billion consensus estimate.
It blew right past it.
It honestly reminds me of the Transcontinental Railroad. Like, Alphabet isn't just running the shiny new passenger trains, meaning the AI software itself. They are literally laying down the steel tracks that every other enterprise on the planet is forced to ride on if they want to get to their destination.
That railroad analogy is spot on. I mean, when you're dealing with numbers in the tens of billions, a 63% growth rate is almost unheard of for an established business segment.
Right, it's massive scale.
Yeah. It means major corporations are literally ripping out legacy systems and migrating their core data infrastructure over to Google Cloud. They desperately need the raw computing power to run their own internal AI models.
And if you look under the hood at how efficiently they're running those tracks, it's wild. Cloud operating margins expanded by a massive 15 percentage points year over year.
Hitting 32.9%.
Yeah. But help me understand that. How does a massive physical division like cloud infrastructure jump 15 percentage points in profitability in just 1 year?
Well, it all comes down to the economies of scale inside these massive data centers. Look, building a hyperscale data center costs billions up front.
Right, the land, the buildings.
Exactly.
Yeah.
But once the physical building, the cooling systems, and the server racks are operational, the cost of adding one more enterprise client to that network is virtually zero.
Oh, I see.
So as Alphabet fills up these data centers with clients demanding high-powered AI compute, all that new revenue flows directly to the bottom line. The fixed costs are already paid for, so the margins explode upward as capacity utilization maxes out.
That makes total sense. But there is a quirk on the bottom line that might confuse someone just, glancing at the headlines.
Ah, yeah. The GAAP net income.
Right. GAAP net income hit $62.6 billion, which translates to $5.11 a share. However, that figure includes a massive $37 billion gain from equity securities.
Which is a huge chunk.
Yeah. And if you strip that away, the adjusted earnings per share was $2.62, which actually missed Wall Street estimates by a penny. So unpack that $37 billion gain for us, because that sounds like paper money, not actual business operations.
That is exactly what it is. It's paper money. Alphabet holds investments in various other companies and startups like their autonomous driving unit Waymo or other outside AI ventures.
Okay.
So when the private market valuation of those investments goes up, Accounting rules require Alphabet to record that bump in value as a gain on their income statement.
Even if they didn't actually sell those shares and put cash in the bank.
Exactly. They haven't sold anything. It creates this wildly inflated artificial net income number.
Got it.
That's why analysts always look at the adjusted EPS, which strips out those paper gains. It tells you what the actual core business earned from selling ads and cloud computing.
Okay, so the core business missed estimates by a penny, yet the stock went absolutely parabolic. Why is Wall Street completely ignoring an earnings miss?
Because of the massive margin expansion in the cloud division we just discussed, institutional investors are looking at the trajectory of the business, not the rearview mirror.
Right, they're looking forward.
Exactly. A 1 cent miss on the bottom line is just a rounding error when your fastest growing, highest margin division just proved it can grow top-line revenue by 63%.
Yeah, that makes sense.
The market realizes that if cloud continues compounding at that rate, with 33% margins, it will just drown out any minor fluctuations in the legacy business.
Which brings us to exactly how they are securing these massive enterprise contracts in the first place. Because, you don't grow a $20 billion division by 63% just through good salesmanship.
No, absolutely not.
They've built this structural advantage that you refer to as their full stack moat.
Right. Alphabet's core advantage is vertical integration. If you look at their competitors, most of them have to rely on third parties to build their AI infrastructure.
Meaning they're piecing it together?
Exactly. They buy their processing chips from a hardware company like NVIDIA. They might license their large language model from a software lab like OpenAI, and then they try to stitch it all together on whatever servers they have.
But Alphabet doesn't do that.
No, Alphabet does everything in-house. They design their own custom silicon, the tensor processing units or TPUs. They write their own proprietary large language models, the Gemini series, and they host it all on their own global network.
It's essentially what Apple did with the smartphone ecosystem.
That's a great comparison.
Like Apple builds the iPhone hardware and the iOS software so they communicate flawlessly together. And that creates this incredibly sticky, optimized experience that users never want to leave.
Exactly.
But Alphabet is applying that exact same full-stack integration to massive global enterprise infrastructure.
And the mechanical advantage of that integration is profound. When you design the physical computer chip specifically to run your own proprietary AI model, you drastically reduce latency, meaning the time it takes for data to travel and process.
Right, just faster.
It is, but more importantly, you optimize the power draw. Electricity is the single largest ongoing expense in a data center.
Oh, wow, really? Not the hardware.
Nope, electricity.
Yeah.
And because Alphabet's TPUs and Gemini models are perfectly synced, they use power much more efficiently than a competitor trying to force an off-the-shelf NVIDIA GPU to talk to a third-party software model.
So they save on energy.
Big time. And that efficiency translates into lower costs, which Alphabet can pass on to their enterprise clients.
And we're seeing the ultimate proof of this full-stack moat right on the balance sheet. Their Google Cloud backlog just nearly doubled to an astonishing $462 billion.
It's a staggering number.
But hold on, let me push back here. A $462 billion backlog sounds fantastic on paper. But in the real world, what stops a competitor from just knocking on the door of those enterprise clients, offering a 20% discount, and poaching them before those contracts even start generating cash?
Well, in the enterprise cloud world, a backlog doesn't just mean a list of interested customers. These are legally binding commitments.
Okay, so they can't just walk away easily.
Right. Corporations have signed multi-year contracts, agreeing to spend a specific minimum amount on Alphabet's cloud services over 3 to 5 years. While a company could theoretically try to break a contract, the financial penalty fees are astronomical.
And I'd imagine, beyond just the financial fees, the sheer technical headache of ripping out your entire digital nervous system and moving it to a competitor has to be paralyzing for a Fortune 500 company.
It would be catastrophic. Once a massive global bank or a retail giant optimizes its internal data pipelines and proprietary apps to run on Alphabet's TPUs and Gemini models, the switching costs are practically insurmountable.
You can't just unplug over the weekend.
No, not at all.
Yeah.
It would require retraining thousands of employees and rewriting millions of lines of code. So while that $462 billion isn't cash in the bank today, it is highly visible, structurally locked-in future revenue.
And that locked-in revenue is exactly why institutional capital is moving so aggressively into Alphabet right now, creating historic price action on the charts.
Oh, the charts are incredible.
Following this earnings release, shares surged nearly 8% to $376.96. That pushed the stock straight into blue sky territory, meaning it hit an all-time high with no historical overhead resistance to act as a psychological ceiling for sellers.
Which is very rare for a company of this size.
Yeah. Just in the month of April 2026 alone, the stock gained 31.4%. That is the best single month for the stock since October 2004.
And beneath that generational price action is a massive rotational trade. Institutional money managers are looking at the landscape and aggressively rotating their capital out of unproven AI concept stocks and pouring it directly into Alphabet.
So the hype phase is over.
Exactly. The market has formally transitioned from the concept phase of artificial intelligence to the cash flow phase.
We saw this brutal reality play out in real time with Meta. Meta actually raised their forward guidance, told Wall Street they were spending heavily on AI, and their stock still dropped 7% on the news.
Yep.
But Alphabet announces heavy AI spending, and the stock skyrockets. So why the massive divergence in how Wall Street treats these two tech giants?
It comes entirely down to commercialization. Meta is spending billions of dollars on AI hardware and infrastructure to improve their own internal advertising algorithms.
Right.
And that will eventually help their ad targeting, sure. But they do not have a commercial cloud business. They cannot rent out that massive computing power to other companies. Alphabet, on the other hand, is building the infrastructure and then actively renting it to the rest of the corporate world.
So Wall Street is aggressively rewarding the picks and shovels infrastructure of Alphabet's cloud, but actively punishing pure software plays that are spending heavily without a direct way to monetize the hardware itself.
That's it exactly. Wall Street demands to see how your multi-billion-dollar server purchases translate into direct, high-margin revenue. And Alphabet answered that demand with 63% growth.
And that tangible high-margin revenue is triggering major analyst upgrades across the board.
Huge upgrades. JP Morgan raised their price target to $460. Yeah, Goldman Sachs took it to $450. Morningstar raised their fair value estimate to $433. Institutional confidence is so high right now that it's actually spilling over into Alphabet's Moonshot division.
Oh, like Waymo.
Yes. The Waymo autonomous driving subsidiary recently raised $16 billion from outside investors. That single funding round values the Waymo unit at $126 billion.
That is insane. Just to put that into perspective for everyone listening, an experimental self-driving taxi subsidiary tucked inside of Alphabet is now worth more than most legacy global automakers combined.
It's hard to even wrap your head around.
It is. But dominating both the software intelligence and the physical infrastructure of the AI boom comes with an astronomical price tag.
Yes, it does.
Servicing a $500 billion backlog requires physical data centers. They have to spend a fortune before they make a dime, which brings us to the $190 billion elephant in the room and the primary bear case for this stock.
Right. The sheer capital intensity of this business model is staggering. Now, Alphabet has a fortress of a balance sheet to absorb this. They ended the quarter with $126.8 billion in cash and marketable securities against just $77.5 billion in long-term debt.
So a net cash position of nearly $50 billion.
Exactly. And the core business is a cash printer. Operating cash flow for the quarter was a massive $45.8 billion.
Now, operating cash flow is great. That's the money coming in the door from selling ads and cloud space. But the massive red flag for the bears is free cash flow.
Which is what's left over after they actually pay for all the physical buildings, land, and servers.
Right. And free cash flow was compressed down to just $10.1 billion. The reason? They spent a staggering $35.7 billion on capital expenditures in Q1 alone.
Just in one quarter.
Yeah. And looking forward, the full year 2026 CapEx guidance is projected to be between $180 billion and $190 billion. To go back to our earlier point, that is more than the GDP of a small nation being poured into server racks in 12 months.
It is. But you also have to remember, management explicitly stated on the earnings call that they are compute constrained.
Meaning that 63% growth rate actually would have been even higher if they could just build data centers fast enough.
Exactly. That compute constraint is a critical detail. It means global enterprise demand is violently outstripping Alphabet's massive supply. That supply-demand imbalance guarantees Alphabet maintains total pricing power in the market for the foreseeable future.
Okay, but wait. Pouring $190 billion into physical hardware carries immense risk. What happens if enterprise demand suddenly cools down in 2027? You are left with the most expensive empty warehouses on Earth.
Well, that's the risk with physical infrastructure.
Plus, we need to talk about the accounting reality of this spend. When Alphabet buys a $100 million server farm today, they don't take that financial hit all at once on the income statement.
Right, they spread that cost out over several years as depreciation.
Exactly. So all this massive $190 billion spending today is going to trigger a massive depreciation wave. It's going to act like a slow, steady weight dragging down their on-paper GAAP profits for the next 5 years. At what point does proactive reinvestment become a runaway spending train?
Look, that depreciation weight is exactly what the bears are modeling, and it is a completely valid concern if you ignore the return profile of the assets they are building.
Okay, explain that.
You have to connect that $190 billion spin back to the 33% cloud operating margins we discussed earlier. They aren't spending blindly on faith.
They already have the demand.
Right. They're converting that cash into infrastructure that yields best-in-class margins and feeds directly into a legally binding $462 billion backlog. It's generating historic returns on invested capital. The high margins on the back end of the cloud contracts more than offset the depreciation drag on the front end.
All right, so if you are sitting at home trying to figure out how to position yourself around a company that is fundamentally supply constrained but printing money, you need to look at the upcoming calendar. Definitely. What are the major catalysts over the next 3 months that could either ease these physical bottlenecks or spark even more top-line growth?
The immediate event on the horizon is the Google I/O Developer Conference in May 2026. The industry is heavily anticipating the release of Gemini 3.5, their next-generation frontier model.
And the expectation is that this model will rival or even surpass the latest iterations from Anthropic and OpenAI.
Exactly. Delivering a superior model is critical because it solidifies their leadership not just in the physical data center hardware, but in the actual cognitive capability of the software, which protects that full-stack moat we talked about.
Then we roll right into Q2 earnings in late July. Given the massive Q1 beat and the raised guidance, market expectations are going to be sitting in the stratosphere.
Oh, expectations will be huge. Alphabet will have to prove they can maintain this altitude and continue expanding margins while spending aggressively.
We're also anticipating the commercial launch of Waymo via a partnership with Lyft later this year.
Which is huge. They finally have a path to heavily monetize that $126 billion subsidiary and turn it from a cash-burning research project into a revenue-generating logistics network.
There's also regulatory relief on the horizon. For years, the Department of Justice antitrust lawsuits have been a dark cloud over the stock.
Yeah, that overhang has been brutal.
However, recent rumors and legal posturing suggest the outcome could be significantly less draconian than the market initially feared. It looks increasingly likely they will avoid a forced structural breakup of the core search and Android ecosystems.
And removing the threat of a corporate breakup takes a massive overhang of uncertainty off the table for institutional investors.
But we also have to look beyond the tech sector to the broader macro environment, because this is where the digital cloud collides with physical reality. Oil is currently holding between $105 and $111 per barrel, driven by ongoing tensions in the Middle East. And if we see any geopolitical de-escalation, it would actually serve as a major positive catalyst for Alphabet. Trace that mechanism for us. How exactly does a barrel of oil in the Middle East impact the profit margins of a digital AI cloud?
Because the cloud is intensely physical, hyperscale data centers are essentially massive industrial manufacturing plants for intelligence. Building them requires transporting thousands of tons of steel, laying millions of miles of copper wiring, and installing enormous industrial cooling systems.
And none of that happens digitally.
No, the supply chain to move all those raw materials around the globe relies entirely on diesel-powered shipping and freight. Furthermore, once built, these facilities require staggering amounts of continuous electricity to keep the servers from melting.
So they are incredibly energy intensive.
Massively. When global energy prices spike due to geopolitical tension, the physical cost to pour concrete, ship copper, and power the grid goes up dramatically.
So conversely, if oil prices drop back down, Alphabet's physical cost to execute this $190 billion infrastructure build-out drops in tandem.
Exactly. Every dollar saved on shipping steel and running industrial air conditioners flows directly to the bottom line, expanding their profit margins even further.
Wow, so the digital cloud is quite literally built on a foundation of steel, copper, and fossil fuels.
It really is.
All right, bringing all of this together, the historic transition from AI laggard to full-stack leader, the 63% cloud growth, the locked-in backlog, and the massive scale of their infrastructure spending. Let's deliver the final investment thesis.
In our fundamental analysis, Alphabet earns a 9 out of 10 bullish score. We firmly categorize the stock as a multi-year hold.
Give us the 30-second elevator pitch summarizing the strategy.
Alphabet has successfully built an insurmountable full-stack moat, integrating custom silicon with proprietary AI models. They are successfully translating unprecedented nation-state levels of infrastructure spending into highly profitable cloud revenue, de-risked by a legally binding $462 billion backlog.
And the competition.
Competitors relying on third-party hardware and software simply do not have the integrated ecosystem or the balance sheet to catch up in the enterprise space over the next several years.
Awesome. As we wrap up, I want to leave you with a thought that goes beyond the immediate earnings beats or the upcoming product launches.
Let's hear it.
If Alphabet continues to successfully integrate the foundational hardware of custom TPUs with the dominant intelligence of Gemini, and they weave that digital nervous system into the fabric of the entire global enterprise world, are we really looking at a traditional tech company anymore?
That's a fascinating question.
Right. Or are we witnessing the birth of a new global digital utility? Much like the power companies or telecom giants that laid the electrical grids and telephone lines of the 20th century, Alphabet is laying the grid for cognitive compute. And if cognitive compute becomes as essential to human business as electricity, how does that fundamentally change how you value this company and build your wealth around it in the coming decade?